Famed money manager, mutual fund manager Peter Lynch makes a statement at an interview in 1994 about how the stock market works. Let's test that. Going back 27 and a half years, see if he's right. I'll explain coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. So Peter Lynch is one of the most well-known investors of our generation. He was a mutual fund manager of the Fidelity Magellan Fund at Fidelity up until, I believe, 1990, somewhere around there. And he was, became popular because his performance was more than double the S&P 500. It just did astounding during that time period and became famous because of this. And I believe even at the time, he was considered the best mutual fund manager or money manager in the entire world at that time. Now, that's during Warren Buffett's era, so very interesting. But I saw an article that was breaking down some comments that he made during a speech in early October of 1994. Guys, it is just fascinating. He makes a simple statement about how the stock market works, and I want to test whether that applies today and whether this simple statement has turned out to be true. Let's check it out.
Basic corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that. Because profits will go up 8% a year and stocks will follow. That's all there is to it.
Okay, so he's saying basically that the stock market follows the profits. It follows earnings. He's absolutely right. It's all about earnings. And back in 1994, he's referring to the Dow Jones, which is around 3,800 at that time, and said, listen, there's going to be volatility. I'm not sure whether, the next 500 points will be up or down, 600 points will be up or down, but I do know the next 3,800 points are going to be up because earnings, corporate earnings, profits tend to grow 8% every year, which means the market should double every 9 years and the stock market's going to follow, or corporate profits should double every 9 years and the markets will follow those. Guys, is he right? Let's check his math and then dive a little bit deeper. Okay, so if the Dow was around 3,800 at the time he gave that speech, we're now 27 and a half years later. By compounding that 8% growth rate, that should mean today the Dow should be around 31,520. And we are around 3,500 with the Dow. Pretty stinking close. Now you might say, well, that's not close enough. We're 10% off there. But a 7% compound growth from 27 and a half years ago would get you around 24,000. Okay, we're not there. A 9% growth rate over that time would get you to around 40,600. We're not there yet. So yes, it's around 8% growth rate. We're just a little bit higher than that. Let's check it on the S&P 500. At the time that Peter Lynch gave that talk, the S&P 500 was around 455. Can you imagine that? Because right now we're over 4,000. So if you do an 8% growth rate compound since that time, that would get the S&P 500 to around 3,778. And right now we're around 4,500, 4,600, something like that. A 9% rate of return would have gotten us to 4,800. So guys, his math is right. The math is right. So guys, I've been doing this 20 years, and yes, there's always distractions. There's always current events. There's always things that are going to be pushing the market around, but the market's going to follow earnings. Okay, so if he's right and the math works for this 27 and a half year time period, let's then break into what he says, go a little bit deeper into what he says to help all of us have a better perspective about what to expect in the market moving forward. Number one, he says, listen, there's going to be some event There's going to be some event that comes out of left field, I think is what he says, that's going to push the markets down or push the markets up, okay? There will be volatility. He's right, and we're seeing it right now, right? With Russia, Ukraine, no one could have expected that that was going to happen at this time. Coronavirus, no one was going to expect that that was going to happen. We still don't know what the actual ramifications will be of all this money printing. I mean, guys, it's unprecedented, and we're not exactly sure how that's going to all pan out in the economy and the stock market. So yes, volatility is a feature of investing. It is a feature. It's not an exception. That is just part of investing. There will be volatility, some up, some down, some events going to come out of left field. He's absolutely right. And then the second point he makes, again at the time, is he says, I'm pretty convinced the next 3,800 points will be up. I don't know about the next 500 or 600 points. Those might be up, they might be down. But I do know the next 3,800 points will be up. Oh my goodness, guys, that is so helpful. And let me put it into today's context. I'll say it differently. I don't know if we're going to see a 15 or 20% drop in the markets. That could happen and may happen between here and the next 100% increase. So that's just another way of saying there's going to be volatility along the way, but because earnings should be growing and have grown at a pretty steady rate over time, we might see some volatility and we will see some dips along the way, but the march between where we are right now, so if you're Dow, 35,000 and 70,000, okay, we might see a 20%, 15% pullback along the way. I'm sure we will, okay? But the next 35,000 point swing is going to be up, okay? It won't go from 35 to 0. It'll go from 35 to 70, but there will be a lot of ups and downs along the way. To geek out on this a little bit more, I said that, okay, if you take that 8% growth rate from where the Dow was back when Peter Lynch gave that speech, we'd be around 30,000. We're actually around 35,000. So the market is a little bit higher than that original math of 8% compound. Well, if you go a little bit deeper, okay, the earnings per share, the actual profits, that 8% profit growth rate, we're actually a little below that, okay? We're a little bit below that right now. So the stock market is a little bit high compared to the actual earnings per share. Well, yeah, guys, I've been telling you that for a while now. That valuations seem a little stretched. So that suggests we very well could see a 15, 20% pullback at some point soon, actually, over the next year, couple of years. That's going to be likely. However, the long-term trend, if corporate profits continue on their historic trend, okay, should push the markets higher, doubling about every 9 years. And then speaking of that, let's go into that third point. Because the market follows earnings and earnings grow about 8% a year, take a look at historic earnings here. That's not flat. He said, yep, about 8% growth rate every year, but it's not each and every year. There's obviously some cyclicality to it, if that's a word, right? It's going to move in cycles based on, are we in a recession? Are we in expansion? Where are we, right? But over time, yeah, an 8% growth rate to corporate profits is expected over a long period of time. And because the market follows earnings, you'd expect the stock market to do the same. Guys, I know that's a lot, okay, but hopefully that gives you some confidence, because I do have a lot of concern about the near term. We've got a lot of converging issues right now in the economy and in the markets that the outlook over the next 12 to 18 months might be a little rocky. This gives, but basically Peter Lynch says, yes, yeah, I don't know where the next 500, 600 point swing would be, or in today's world, the next 5,000 or 6,000 swing will be. I don't know. It could be up, it could be down. However, the long-term trajectory, because the markets follow earnings and earnings tend to grow about 8% a year on average, then the long-term return, the next 10 years, we should see the next 9 years should see the market double. Are you structured to participate in that in your financial life? Are you saving the right amount into your long-term investments? Do you have the right long-term investment structure? And are you doing what's necessary with both of those to achieve your long-term goals? Work with your certified financial planner on that. I hope while this is detailed, I hope this is a breath of fresh air and some encouragement to you during a volatile year thus far, in the midst of what could be some, a lot of volatility over the next year or so. I hope this is encouraging to you. Work with your CFP on all of that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.